Welcome to the Deep Dive. If you're listening to this, you're probably the kind of person who knows that the official headlines, they don't really tell the full story.
Not even close.
You want to get behind the curtain. You want to see the mechanics, the hidden facts. And today, we're going inside the inner sanctum of global finance to hear what the world's central bankers are actually saying to each other.
And our deep dive today, it's all built on one single, really extraordinary source. It's a confidential account, firsthand from an economist. And he was kind of unexpectedly present at what was supposed to be an informal consultation.
Supposed to be.
Yeah, but it very quickly turned into an emergency gathering. And this wasn't in some public conference hall. This was in Basel, Switzerland, at the Bank for International Settlements, the BIS.
Okay, let's just stop there because the gravity of that setting is huge. The BIS, I mean, that's the central bank for central banks.
Exactly. This is where the people who run the system go to talk without anyone listening.
So who was there? We're talking about, what, maybe 30 of the most powerful people on the planet. Deputy governors, senior policy advisors from the Fed, the ECB, the Bank of England, Bank of Japan, all the big players.
All of them. And the official agenda, the piece of paper they handed out, said monetary policy normalization.
Which sounds incredibly boring and bureaucratic, sort of an official shrug like everything's under control.
But the reality, according to our source, was anything but normal. He describes this atmosphere of, and I'm quoting here, palpable panic. The real goal wasn't policy review. It was crisis management. It was collapse preparation.
Wow. So our mission today, for you listening, is to pull out the 5 key revelations from that meeting. The things that confirm the whole dollar-based system isn't just struggling, it's actively on its way out.
And the initial assessment from our source, this is what sets the stage for everything. He said the officials know the situation is, quote, worse than I've said, and they have absolutely no idea how to stop it.
High knowledge and zero ability to act. That's terrifying.
It is. It means the people in charge have basically admitted defeat. They're not trying to prevent the collapse anymore. They're just trying to manage the fallout.
Yeah, it's just a staggering admission. Okay, let's jump right in. What brought them to Basel in such a panicked state? Let's start with the crisis they just couldn't ignore anymore.
Right. So the conversation in that room, it didn't waste any time on, minor policy adjustments. It pivoted, and it pivoted hard. Our source talks about a senior Fed official who just cut through all the noise.
What did he say?
He said, we need to stop pretending this is manageable. This isn't a policy challenge. This is crisis management.
Crisis management. I mean, that's a completely different world from monetary policy. That's admitting the house is on fire.
It's an admission that the tools they have don't work anymore. And the source ties this directly to unprecedented repo market moves after Saudi BRICS. The geopolitics are now driving the entire financial bus.
And this gets us straight to revelation number 1, the hidden treasury exodus. Or as you put it, the official lie.
Exactly. Because this is the core of the problem. Demand for U.S. treasuries, which is the bedrock, the funding mechanism for the entire world, is collapsing. The source is clear. The 3 largest foreign holders want out.
But wait, if you look at the official data, the stuff they released to the public.
Right, the TIC reports, the Treasury International Capital reports.
Yeah, those. They only show, modest declines. The media reports it like it's no big deal.
And that is the official lie that they were dissecting in Basel. A Bank of Japan official flat out confirmed it. He said foreign central banks are dumping treasuries faster than anyone admits.
So how? I mean, how do you hide sales of that magnitude? We're talking trillions of dollars. If a central bank sells, it should show up somewhere.
Well, this is where the financial engineering comes in. First, they are not selling directly on the open market. That would crash the price instantly.
So they're using backdoors.
They're using intermediaries, big global banks, specialized offshore vehicles in places like the Cayman Islands or Luxembourg. So the Bank of Japan, for example, sells a massive block of treasuries to an entity in the Caymans.
And on the public books, it just looks like a private transaction in a tax haven, not a strategic dump by a major government.
Precisely. The seller's identity is masked, but there's a more sophisticated layer, too. They're using what the source calls disguised currency swaps.
Okay, break that down. How does a swap hide a sale?
In a simple swap, you trade currencies, but here they're using treasuries as collateral in these very complex long-term swaps. They basically trade their treasuries for, say, dollars or other assets they want now, but the deal is structured so it doesn't officially register as a sale on their public balance sheet. It's like a synthetic sale.
It's financial sleight of hand.
Yeah.
You get the cash, they get out of the risk, but they keep up the public illusion that they're still holding all these treasuries.
It's all about self-preservation. Because if the true scale of this exodus became public, you'd have a global panic overnight. It would trigger the very collapse they're trying to manage.
And this secret exit leads us right into Revelation number 5, which is just, it's mind-bending. They're talking about managing decline, not dominance.
It's a total paradigm shift. The people in that room, they went to Basel expecting to hear strategies for maintaining dollar dominance, how to prop it up.
But that wasn't the conversation at all.
Not at all. The entire conversation just assumed it was ending. A Fed advisor made this incredible admission. He said, quote, "We need to accept we're transitioning to a multipolar currency system."
So it's not a question of if anymore, it's just a question of how.
Can they manage the transition without a complete collapse? That's the only question left on the table. It confirms, right from the horse's mouth, that the dollar's unchallenged reign is over.
And the source is very specific about the catalyst. It was Saudi Arabia joining BRICS. That was the event that forced the emergency meetings.
It absolutely was. For 50 years, the petrodollar system was the guarantee. Oil was priced in dollars, so everyone needed dollars. Oil nations then recycled those dollars back into U.S. treasuries. It was a perfect self-sustaining loop.
A guaranteed demand mechanism.
The gravity well for the entire system. When Saudi Arabia, the absolute linchpin of that system, officially joins a bloc that is actively trying to de-dollarize.
The guarantee is broken. The automatic demand is gone.
And suddenly, everyone has to look at the U.S. debt market on its own merits, and, well, the fundamentals aren't good.
But this isn't just about the U.S., is it? The collateral damage here is huge. The Europeans seem especially exposed.
Oh, massively. The ECB official in the room was apparently very grim. He openly said Europe is worse positioned than anyone else.
Why? What's their specific vulnerability?
A few things. A collapsing industrial base because of insane energy costs, and almost total dependency on foreign energy, and critically, no unified military to project power in this new multipolar world.
So they're basically passengers in a car that's about to crash.
That's the feeling. He literally said Europe will be collateral damage when the dollar system restructures. They're stuck. They're too dependent on the old system but have no real power to shape the new one.
Okay, so there's a massive hidden stampede out of U.S. debt. And the people in charge admit the dollar's era is over. But the panic wasn't just about trust. It was about the actual pipes and gears of the system starting to break down.
That's exactly right. The geopolitics expose the cracks, but the immediate crisis is a mechanical one. And that brings us to Revelation 2, pricing in treasury risk. And this all comes down to the repo market.
Okay, we have to spend a moment on this because repo market sounds so technical. For you listening, why is this system's plumbing? What happens when it gets clogged?
Think of it as the ultimate pawn shop for big finance. It's where banks and hedge funds get huge amounts of cash, usually just overnight.
Right.
They put up an asset, almost always a U.S. Treasury bond, as collateral, get cash, and promise to buy it back the next day for a tiny bit more.
And that tiny bit more is the interest, the repo rate.
Exactly. It's the mechanism that makes a Treasury bond as good as cash. It's the bedrock of global liquidity.
And according to the source, since that Saudi BRICS moment, this plumbing is backing up. The repo rates are spiking all over the place.
Violently and erratically, and banks are demanding higher rates to lend against treasuries. This is the critical part.
What does that signal?
It signals that the market is now actively pricing in treasury risk. For decades, a U.S. Treasury was considered risk-free. It was the safest asset on earth. Now, the very market that uses it as collateral is saying, wait a minute, I'm not so sure about this.
Just to be clear, we're not talking about the risk of the U.S. government actually defaulting, are we? Like not paying its bills.
That's a great question. No, it's not primarily about default risk. It's about liquidity risk and collateral risk.
Okay, what's the difference?
Liquidity risk is the fear that you might not be able to sell the bond quickly in a crisis, but the bigger one is collateral risk. That's the fear that the value of the bond you're holding as collateral could suddenly plummet if interest rates spike.
So the financial system's biggest players are now betting that the world's safest asset is no longer stable.
And this is unprecedented in peacetime, according to the source. The Fed is having to intervene constantly just to keep the system from seizing up. They're pumping in massive liquidity day after day just to smooth out these spikes.
But they can't do this forever. I mean, the very definition of a risk-free asset is one that doesn't need constant life support from a central bank.
It's a total fiction now. It's a Band-Aid. And when that plumbing finally breaks, liquidity for the entire economy, mortgages, business loans, everything, it just freezes. A total credit crisis.
And if the plumbing is about to burst, the next logical step is to, well, shut off the water main. Which brings us to revelation number 3, capital controls.
And this is where it gets really frightening for you, the listener, because this is about your money. The force confirms that Western central banks are secretly prepositioning measures that are usually only for, a full-blown currency collapse.
Capital controls, let's be very specific. What does that actually mean?
It means the government restricting your ability to move your own money, particularly across borders. It's the digital equivalent of locking the doors of the bank to stop a bank run.
Were there specific examples discussed in Basel? What would this look like for someone with a bank account in, say, London or Paris?
Oh, yes. The Bank of England mentioned they have emergency protocols for capital controls ready to go.
Protocols for what exactly?
Things like restrictions on wire transfers over a certain amount. Maybe you can't send more than 10,000 euros abroad without special permission. Or mandatory waiting periods. You want to move a large sum, you have to wait 72 hours.
To give them time to stop the bleeding.
Exactly. The Swiss National Bank even confirmed they're coordinating with the ECB on things like dollar-euro swap limitations and currency conversion restrictions.
Wait, currency conversion restrictions?
Right.
So they could literally stop you from exchanging your pounds or euros for dollars or gold or anything you think is safer.
That is precisely what it means. It's a plan for a scenario where public trust completely shatters and everyone makes a run for the exits at the same time. Their only tool left is to trap your money inside the system.
Which is terrifying. And the final revelation in this section explains why they expect that public panic. Revelation 4, the pension time bomb. This is the social unrest part of the equation.
Right. This is where high finance hits Main Street. Hard. For years, pension funds had to find safe, long-term investments, so they bought trillions in U.S. Treasuries when interest rates were near zero.
But when interest rates go up, the price of all those old low-interest bonds goes down, and rates have been going up a lot.
Dramatically. And the officials in Basel, they were looking at the cold, hard math. They calculate a potential loss of $3 to $5 trillion for pension funds if rates just rise another 200 basis points.
2%. That doesn't sound like a lot, but you're saying it could cause a multi-trillion-dollar hole. Why is it so sensitive?
It's because of something called duration risk. Pensions need to pay out retirees in 20 or 30 years, so they bought long-duration bonds, bonds that mature in 20 or 30 years. And those long-term bonds are incredibly sensitive to rate changes. A 20-year bond's price can get hammered by even a small increase in rates.
So a 200 basis point hike is enough to wipe out a massive chunk of their capital, leaving them completely underfunded.
Completely. And here's the policy trap. The thing that guarantees social unrest. The officials admit they have no policy tools to prevent it. They're trapped.
Trapped how?
They have two impossible choices. Choice 1, let rates keep rising to defend the dollar. If they do that, they knowingly trigger the $3 to $5 trillion pension collapse, which creates enormous political pressure when millions of people see their retirement savings vanish.
Okay, that's bad. What's choice 2?
Choice 2, cave to the political pressure and print trillions of dollars to bail out the pensions. But they know they can't print our way out without accelerating inflation and devaluation.
So they either trigger social chaos now by letting pensions fail, or they trigger it later through hyperinflation.
It's a choice between a heart attack and terminal cancer. There's no good outcome. And they know it.
So if the first 2 sections were about the diagnosis, this next part is about how it all ends. The conversation in Basel shifted from what's wrong to what is the specific thing that pushes us over the edge.
And this was all kind of summed up by a young Nordic central bank official. His assessment was just chilling.
It was. He just said no pathway ends well.
No pathway ends well. That's complete policy resignation.
It is. He said their best case scenario is a slow decline over a decade with moderate pain. That's the managed collapse they're hoping for. But the worst case,
A sudden crisis, markets freeze, currencies collapse, social unrest.
and the general feeling, the source said, was this sense of total desperation. It was, we're basically praying nothing goes wrong while we prepare emergency measure.
They're not governing, they're just bracing for impact. They know the system is so fragile now that any shock could set it off. And they identified 4 specific triggers, 4 scenarios that are keeping them up at night.
Okay, let's go through them. Scenario 1, Treasury auction failure. This sounds technical, but it feels like the most immediate threat. What happens if the U.S. tries to sell its debt and nobody shows up?
The U.S. government runs on debt. It's constantly holding these auctions to sell new bonds to fund itself and to pay off old bonds that are maturing. But the buyers, especially the foreign central banks we just talked about, are disappearing.
So if an auction fails, if they can't sell enough bonds at a reasonable price, it's like a giant rejected stamp on U.S. credit.
It's the official signal that the world no longer wants U.S. debt. And the chain reaction would be immediate. Interest rates would have to spike to attract any buyers at all. Markets would panic. Every single person and country holding treasuries would rush to sell before they become worthless.
A cascade failure. What was their emergency plan for that?
The nuclear option. The Federal Reserve would have to step in and buy unlimited amounts of its own government's debt.
So the Fed just prints money to buy the bonds that nobody else wants.
Yes, it prevents the immediate market crash, but it triggers something worse. A dollar confidence collapse. The second the world sees that the only buyer for U.S. debt is the U.S. itself, the dollar's status as a global reserve asset is over. Instantly.
Wow. Okay, what's scenario 2?
Scenario 2, BRICS currency launch. This is the big geopolitical threat. It's not just a threat, it's the creation of a viable alternative.
And we're not just talking about them trading in their own currencies. We're talking about a new, separate currency.
Specifically, the threat of them announcing a gold-backed or commodity-backed currency for trade. Something tangible.
So instead of settling oil sales in dollars, they could do it in this new currency that's backed by a basket of, say, gold, oil, wheat.
Exactly. And that would provide an immediate, credible alternative for global trade. Countries, especially commodity producers, would shift away from the dollar in a heartbeat. Dollar demand worldwide would just fall off a cliff.
This is a direct attack on the petrodollar system.
Nah.
What was their plan to counter this?
This is the scariest part. Our source says the only countermeasure they could come up with was, and I quote, hoping it doesn't happen.
They have no plan.
They have absolutely no plan. They know it will be catastrophic, but they have no tool to stop it from happening.
Okay, moving on. Scenario 3, geopolitical crisis and sanctions.
This one is a direct consequence of their own past actions, specifically freezing Russia's central bank assets in 2022.
They taught the world a lesson.
They taught the world that dollar assets are not safe. They can be confiscated. So the scenario is another major conflict. Taiwan, the Middle East, whatever. And the U.S. uses the same playbook. It freezes the assets of another country.
But the people in Basel realize the rest of the world has learned from Russia.
They know that if they do it again, every other country holding dollars, even allies, will panic. They'll see it happen a second time and think, I could be next. And they will all rush for the exits at once because they have learned from Russia. It would turn the hidden treasury exodus we talked about into an open, uncontrolled stampede.
It's not an economic problem at that point. It's a trust problem.
Yeah.
And you can't fix trust with interest rates.
Once it's gone, it's gone.
And that leaves the last one, the domestic trigger. Scenario 4, pension panic and death spiral.
This ties right back to that $3 to $5 trillion time bomb. The scenario starts when the general public finally realizes their retirement accounts are being wiped out by these bond losses.
And they start pulling their money out.
Mass withdrawals. But a pension fund can't just hand over cash. To meet those withdrawals, they are forced to sell their assets.
Which are mostly those same undervalued treasury bonds.
So they're forced to sell into a falling market, which pushes the price of bonds down even further, which causes more losses for the pensions that are still holding them, which triggers more panic and more withdrawals.
A death spiral.
A classic death spiral. And the central bankers are terrified of this one because it translates directly into social unrest. The promise of a secure retirement broken for millions of people. The political system can't contain that kind of anger. So, faced with these 4 nightmare scenarios, the conversation in Basel wasn't just theoretical. It was about what they're actively doing right now, the emergency measures being prepared. And these aren't ideas on a whiteboard. These are protocols ready for instant activation.
First on the list, a classic central bank play. Prepositioning dollar swap lines.
Right. Swap lines are basically agreements where the Fed can provide emergency U.S. dollars to other foreign central banks in exchange for their currency.
A global dollar liquidity fire hose.
Exactly.
Yeah.
And the fact that they're getting them ready at maximum capacity means they expect a sudden, severe global shortage of dollars, a global margin call. They're setting up the financial triage centers ahead of time.
Okay, the second one is much more direct and, frankly, invasive. Drafting protocols for temporary capital controls.
We talked about what this means, but the source stressed how operational the planning is. They are literally drafting the rules for restricting your wire transfers, for mandatory waiting periods, for limiting how many of your euros you can convert to dollars.
They're building the digital cage for your capital, and it's ready to go at a moment's notice.
The third measure they're preparing is bank holidays.
Wow. That's a term you hear in, like, history books about the Great Depression.
And it means the same thing now. A bank holiday is when the government just shuts down the banks and the markets, maybe for a day, maybe for a week. It's a desperate move to stop an uncontrolled panic.
It gives them a moment of silence to try and figure out what to do without the market screaming at them.
Exactly. The fact that this is on the table, that the protocols are being prepared, tells you everything you need to know about how close to the edge they think we are.
And finally, the last resort. Preparing for extraordinary monetary operations.
Which is a fancy way of saying unlimited money printing to buy government bonds. It's the only answer they have for scenario 1, the Treasury auction failure.
So they know it's a terrible idea that will destroy confidence long term, but they're getting the machine ready anyway because it's the only tool they have to prevent an immediate overnight collapse.
It's designed to buy them hours, maybe days, not to solve anything.
Which leads right to their own candid admission about all of this. The inadequacy of the tools. They know this is all just tape and glue.
They were brutally honest with each other. The source said they openly admitted none of these solve the underlying problem. They are just buying time.
And the underlying problem is what? Too much debt? Geopolitics.
It's all of it. It's
Yeah.
a fundamental global loss of trust in the entire U.S.-centric system. And you can't fix that with a swap line or a bank holiday.
That Nordic official had that analogy that just, it perfectly captures the mood.
It really does. He said, we're like doctors treating a terminal patient.
Meaning they can manage the symptoms, they can give you painkillers, maybe extend your life by a few months.
Make the decline less painful, maybe, but they can't cure the disease. And the disease is a global economic order built on assumptions that are no longer true. The core assumption of unchallenged American dominance is just not true anymore, and the entire financial system was built on it.
So what's the timeline? If they're actively preparing for this, what's the window they're looking at?
This is maybe the most actionable piece of information. The crisis window they're working with is 12 to 18 months, maybe less.
So they are preparing for a major systemic crisis by the end of 2025 or early 2026.
That is the operational timeline for which these emergency protocols are being designed.
And are there specific indicators, tripwires that you, listening at home, should be watching for?
Yes, they mentioned 3. First, Treasury yields. If they stay above certain levels for too long, it means the U.S. debt is becoming unaffordable. Second, repo rate volatility. If you see the plumbing constantly needing emergency repairs from the Fed, it's a huge red flag.
And the third,
Gold. Gold prices sustaining above new high levels. That's the signal that big money institutions, other countries, is fleeing the fiat system entirely for a hard asset they can hold outside the system.
and any of those big triggers, the BRICS currency, a war that could compress the timeline from 18 months to.
Dramatically, the source said, could be months or weeks. They know the clock is ticking much faster than anyone thinks. So we have to end on this central paradox, this huge media disconnect. You turn on the news and you hear about economic resilience, a soft landing.
But the people who actually run the system, who see the secret data, they are panicking behind closed doors.
And they have made a deliberate choice not to warn the public. They believe that telling you the truth would accelerate the collapse.
That's an incredible statement. The stability of the system now depends on your ignorance. They need you to keep playing the game to buy them a little more time.
Which leaves you, the individual, completely exposed and unprepared. And that brings us to the single most shocking piece of advice that came out of that room, advice on how to prepare.
People always ask, should I buy stocks, gold, Bitcoin? But that wasn't the advice from the central banker.
Not at all. He said gold is maybe a safe haven, but offered no guarantee. His assessment was brutal. He said if the dollar system breaks, everything breaks initially.
The contagion is instant. Everything is too interconnected.
So his final advice wasn't about financial instruments at all. It was about reality. He said, and this is a direct quote, "Best advice I can give people is to have useful skills, strong community ties, and some physical assets, because if this goes really bad, financial instruments won't matter as much as real-world resilience."
Let's just unpack that. A central banker, one of the high priests of the financial system, is telling you that in the crisis he sees coming, financial instruments won't matter.
He's telling you that their own emergency measures, their capital controls, their bank holidays won't be enough to protect your wealth. He's advising a return to tangible value. What can you do? Who can you rely on? What do you physically own?
The panic, the secret meetings, the 12 to 18-month timeline, it all leads to one conclusion. We are not heading toward a crisis. We are in one. It's just not acknowledged publicly yet.
The fire's already burning in the walls. They can just still smell the smoke.
So the final question is for you. The people in charge, the people who see the whole picture, are terrified. They are planning to lock down the system. They believe their own tools won't work, and they're operating on a timeline that ends in late 2025. How should their panic inform your own sense of urgency? You now know what they know. What are you going to do?